is about today. And welcome to the 11th conference, the Emerging Markets Conference of 2020. And we would like to thank the Chennai Mathematical Institute, SHN Center for Financial Studies, as well as Dwara Research and Vanderbilt Law School. So thank you for helping us organize the event. And we've got three papers followed by a panel discussion about how to do better on measuring financial inclusion, which I'm very excited about. And yeah, so the the discussion is going to go such that the author is going to get 15 minutes to present. I'll let you know when you have 2 minutes left so that you can wrap up. That will be followed by a discussion by the discussant. That's for 10 minutes. Again, I'll give a 2 minute marker. And then we'll open up the floor for discussion to the audience. And that will also, we would like to limit that as well to 10 minutes. So without further ado, let's begin. I invite Amit Kumar. He's a PhD student at the Hong Kong University of Science and Technology to please begin with his paper.
Actually, you can impose time limits pretty well. Just mute us.
I might.
Thank you.
But this is not presidential debate, you know. But okay, yeah, sure. So thank you everyone for joining us today. And I really want to thank the organizers to give me this opportunity to present this paper. So this is my job market paper, which I'm working for quite some time now. And after 1 year, I'll be on the market. So it's really valuable to receive some views and feedback on this work. So this is a paper about credit reports and the retail mortgage, like the retail consumer participation in the market. So I'm Amit at Hong Kong University of Science and Technology. All right, so, oops, sorry. Yeah, so to begin with the motivation, so the idea for this paper came with this particular observation is that consumers seem to have imperfect knowledge of their creditworthiness. Now, why do I start with that is this idea that when we look into the US mortgage market, we see that from 2000 and 2008, 2 out of every 5 mortgage rejections actually happened because of credit history or bad credit history. What is more interesting to look at is that the second most top reason was debt to income ratio, but this debt to income ratio accounts for only half as many credit history rejections as the credit history does. What does this basically means is that most of these rejections, or at least half of them, are happening not because borrower cannot pay it, but because they simply have a bad credit history. And on top of that, we know that these mortgage rejections are costly. They're costly because they involve a direct application fee, which can be as high as $300 to $400 US. And the current rejection affects the future rejection probabilities and future interest rates as well. So despite having all this direct and indirect cost, what we see is that there are a lot of rejections that's happening, not because of not having the ability to repay, but because of having a bad credit history. Now we look at the second piece of data, which the literature calls it as discouraged borrowers. What does this basically mean is that why should I ask if I know that I'll be rejected anyway? Now, what happens is that, is this phenomena common among the retail consumers? So it indeed is, at least from the US Survey of Consumer Finances, which is a survey of representative households in the US, we see that about 15% of the US households report in the survey that they wanted to apply for credit, but they didn't because they thought that they will be rejected. Once we look into, so this phenomena is not only common for retail consumers, but it also exists in SME firms. So when we look into this particular study by Friel et al. 2012, what they find is that in UK SME firms, the number of firms which actually didn't apply for credit to banks was twice the number of firms which actually applied and got rejected. So that again suggests that there is this discouraged borrowers phenomena, or otherwise we can view this as a latent demand for credit, which exists, but a lot of these actors are not coming into the market because they simply expect that they will be rejected. So, and the third piece of information comes from this particular survey, again in the US, which is Perry 2008. What they find is in their retail survey that 37% of the retail consumers, 37% of the respondents actually made wrong self-assessment of their creditworthiness. So when we combine all these things, it seems to be the case that actually consumers seem to have imperfect information of their creditworthiness. Now, this brings to the research question of my paper, which is to examine the causal link between the cheaper credit reports, which where by cheaper, I mean the lower economic costs of credit reports, and the mortgage demand and approval ratio. So I would skip the literature for today, but there is a long literature about financial literacy or the mortgage expansion and also information disclosure that speak to these issues. So what should be the mechanism? How do we see the link between credit reports, the cheaper reports, and the mortgage demand and approval ratio? So what I have in mind here is a consumer self-learning mechanism. So idea is very simple, is that credit report uses we see unconditionally in US is quite low. Out of 1 billion credit reports that are issued, less than 0.05% goes to the consumers. So consumers typically are not very proactive in terms of asking for their own reports. Now, what happens is that credit reports are the document, the authoritative document that contains the piece of information about the creditworthiness of the borrowers or consumers. And at the same time, this happens to be the document that the lenders look at when they are going to decide on these mortgage applications. So the idea is that if consumers use these credit reports more often, they would be better in terms of knowing their creditworthiness, and then they can make better credit-related decisions. Some of these steps that they can take is, for example, if my report is not good, I can save the cost of a rejection by delaying my application or maybe trying to correct the credit history. Or maybe I search for a more suitable or say subprime lender rather than going to a prime lender and getting rejected. Or maybe if my report really looks bad, then I don't apply at all. So once we expect this thing to happen, what would be our prediction is that we'll have a better informed consumers in the economy, and that should lead to a better pool. And once we have a better borrower pool, that should lead to an increase in approval ratios. At the same time, what should happen to the demand for credit? Now, this is the part which is ex ante not clear. It really depends on the proportion of consumers in the economy who underestimate or overestimate their own creditworthiness, and the proportion of consumers who really are not aware that credit reports are an important piece of information that will be looked at once they are applying for any kind of credit or mortgage in particular. So demand may increase or decrease. So that remains to be seen once we look into the data. So in my study, I find that both of these things happen. The approval ratios improve and the demand for credit improves as well. Demand for mortgage credit. So my paper is on mortgages. So then, as I said, my idea is to use to establish the causal links. So how do I do this? So I use a natural experiment in the US. So what is this natural experiment? So this is basically relies on the enactment of Federal Fair and Accurate Transactions Act of 2003. In short, it's called FACTA. Now, what this act does is it's a federal level law which allows each consumer in the US to access free credit reports from the 3 credit rating agencies for free annually. Now, what is interesting is that 7 US states already had free credit report laws. So I call these 7 states as pre-FACTA states. Now, what this allows us to do is it creates this geographic discontinuity in which we have certain states which already had free credit reports or where the credit reports were cheaper. And we have these new states which got the free credit reports now. So I'll use these older states as a control states, and I'm going to use the states that surround these states as the treatment states. And then I'll use the typical difference in differences design to identify the causal effect of free credit reports or lowering the cost of credit reports on the 2 outcome variables. Now, the event is precisely timed at the establishment of this government website, which is called www.annualcreditreport.com, which came after the act came, and this was the website established to distribute the free credit reports. So how does the empirical setting look? So this is the empirical setting in which the states in the maroon, these are the 7 states which already had free credit report laws. So Colorado in the middle, and then we have a bunch of states on the eastern side and Georgia on the southern side. All the blue states which are surrounding these maroon states are the states that is going to be the treatment states in my DID setting. But instead of relying on the state level differences, I go one step deeper. And what I do is I'm going to remove all the inner counties of these states. So counties in the US are like perhaps a little bit bigger than the districts in India. So basically, we are going to remove these inner counties of all these states. And what we are going to compare the counties that are at the border on the other side, which are the treated states, and compare with the counties which are on the control side. So that allows us to remove a lot of local economic changes that might be happening at the same time, so we can control for it very flexibly. And it improves the identification. So finally, before going into the result, we would want to make sure that there was increase in consumer interest in terms of free credit report. Or in other words, we would want to make sure that actually this law created certain interest and there was increased take-up of free credit reports by the consumers. This is something which is not directly observable, at least so far. So what I do is, in this graph, what I'm plotting is the Google searches for the term free credit report. This data starts in 2004, and the two series that we see here, the blue ones are the treated states, and the red ones are the control states. And what we are looking at is the mean number of searches, or in other words, the popularity of the term free credit report into these two different set of states. What we see here is that in 2004, once the website is not established, once the event has not happened, in terms of popularity, these two states are very similar. But once we move to 2005, once the website is established for the free credit reports, the interest differentially increases in the treated states. Now, you might wonder that why the interest is going down in the control states. That happens just because of the mechanical construction of this particular index by Google, which we do not have access to the underlying data. So basically, it's a rank measure. So if some states go up in the rank, the other states go down in the ranking. But the key message to take away from this graph is that the consumer interest in free credit reports increased after the event into the treated states than the control states, which gives us certain assurances that indeed there was a consumer interest increasing into accessing their credit reports. Well, so this is the data and some of the statistics. So the data comes from Home Mortgage Disclosure Act, or popularly known as HMDA dataset. And then there are certain other standard datasets like Fannie Mae and Freddie Mac data and Equifax data. I would skip the summary stats for now. So let's look into the results. So the baseline specification of the paper is the standard two-way fixed effect PID estimators, or otherwise known as generalized DID. So one of the things to note here is that we have the census tract fixed effects. So what are census tracts? These are even smaller units than a county, which represents roughly an area which will have approximately 2,000 to 4,000 residents living into those areas. So we have a census tract fixed effects here, which controls for any pre-existing differences at a very fine geographic level. And then we also have here a border cross-air fixed effect, which basically what allows us to do is it can control for any local economic shock that might hit, let's say, Midwest of the US, but not on the eastern state. That can be taken care with this border cross-air fixed effect. So this is basically takes care, we are going to compare only within a border at one location and the other location. We are not comparing eastern states to the Midwestern states, in other words. All right, so what are the baseline results? So what we are looking at here in column 1 and 2 is basically the number of mortgage applications, which I call as a raw demand per 1,000 adult in the census tract. So what we see here is that it increases by about 13 per 1,000 or about 15 per 1,000, depending on the specification. And what it roughly means is that the number of raw mortgage applications increased by about 13 to 16%. It roughly represents about 38 billion in terms of the raw demand, only if we only multiply it by those treated areas that we saw earlier. Now, in column 3 and 4, I'm plotting I am showing the regressions for the approval ratios. So this basically means how many applications are approved out of 100 applications that were received. So we see that the approval ratios again increased by 1 percentage point in the treated area, while comparing for a similar trend on the control areas. And finally, in 5, yeah. 3 minutes left?
No, it's
okay.
2. Yeah.
Okay, 2 minutes. Okay, I'll rush it up. So in 5 and 6, we see that house price index, there is increase. The effect is not that strong, but we see that house prices also responded to it. What should be the takeaway from here is that we would expect that good borrowers should select in the market. The bad borrowers might exit the market, and that's why we see the improvement in the borrower pool that should be reflected into the approval ratios. Now, this is the time trend, and we see that the parallel trends kind of looks to to be applying here. So no pre-trends before, but we see that the approval ratios increase after the event. Here, what we are plotting is, this is probably the most direct evidence that the borrower pool is actually changing. So what is here we are seeing is the percentage of population in a county that is subprime. And what we see is that this tend to be increasing before the event. 1 year after, the treated states, the subprime fraction of the population starts going down. It goes down by about like 0.5 percentage, but this really directly says that overall the counties are becoming better in terms of their creditworthiness because their subprime population is going down while we are controlling for similar trend going on in their neighboring counties. So here, what we're looking at is the mortgage default. The idea is that if we know that there were more applications and more origination that happened into these treated areas, did they default more? If they defaulted more later, then it's not really good for the economy because we just got a bunch of bad borrowers into the market. But this really didn't happen. What this blue line basically means here is that as long as it's less than zero, then these new loans from the treated areas are less likely to default. And we see that for most of the time, up to 6 years since origination, these mortgages are less likely to default than when comparing for similar trend into the control area. So overall message that it seems that the borrower pool improved. There were more origination that happened, approval ratios improved, and at the same time, there were less defaults observed. And also even during the financial crisis, which appears somewhere here in these areas. So this, I suggest, is something that it was perhaps a good outcome that could be expected once credit reports are more widely used among the consumers. In interest of time, I would skip the discussion of the other results. So this is the conclusion from the paper that I want to emphasize. So first, if we lower the economic cost of credit reports, or in other way, if we provide information at a lower cost to the consumers in terms about their creditworthiness, it seems to suggest that the borrower pool improves. And this is consistent with the consumer self-learning mechanism. And overall, this finding is not only about the mortgage-related decision, but I would expect that any policy intervention or any intervention that is based on educating consumers about their credit reports might lead to similar outcomes. So that is my presentation. Thank you everyone for listening, and I look forward to discussion by Vimal. Give me a moment, I will unshare my screen.
Sure.
Right.
Thank you, Amit. I would,
Ali just came.
sorry, Harsh, could you please mute yourself? I would now invite Vimal to discuss the paper. You'll get 10 minutes. I'll let you know at the 2-minute mark. Thank you, Amit. That was a great presentation.
I had myself on mute, sorry. Can you see the slideshow now?
Yes, it's visible.
Okay. Okay, so thanks a lot for that very sort of comprehensive presentation, Amit. I'm just going to do a quick overview of what Amit just explained to us. The big picture setting is in the United States, 1 in 5 mortgage applications were typically rejected in this period. And credit history, or any reason associated with credit history, forms the bulk of this rejection. The big question is, well, if firms have access to this information, what happens when we allow consumers to also have access to this credit history before they take decisions? This has implications for households that are trying to borrow, and those implications are straightforward. For instance, if I have a poor credit history, then I may choose actually to not borrow or go on the market to even apply for a loan. If I have a good credit history, but I think I don't, when I look at the credit score, it's going to update my information set to believe that I actually can afford to have a mortgage. So in lots of ways, this has a potential welfare improving role for households, because either ways, whether you're going to borrow or not borrow, it's an important information to have to make decisions. But this also has implications for mortgage markets, because this could potentially improve the borrower pool in the market and reduce the costs of screening for good borrowers in the market, because this could reduce the cost, just the existence of the credit report framework. What is really nice about this paper is this information set was already available to firms. Um, can we mute whoever that participant is? Thank you. Yeah, so this paper essentially uses variation from a law introduced in 2005, 6. Sorry, I thought it was 6, but in the United States to shed light on the implications of access to credit report for all of these households. It's an open question. It's a beautiful data set. It's market wide, it's detailed, and it's a lot of careful and thorough work. And I can't believe it's already 66 pages. It's a lot of work. Now, the big picture design point is there were 7 states in the US that had different points in time when they already had access to free credit reports because of their own state local rules. And what Amit does is uses the counties in the bordering districts in bordering counties in other states that did not that got access with the FACTA law, and uses the difference between the two to identify the causal effect for the counties that belong to the bordering states where FACTA came into force. With the assumption being in the control counties, you don't need to worry about it because they already had this information to begin with. Okay? And there are a whole range of outcomes that Amit looks at carefully, but I just want to point out that the most important, rather headline thing that you would start with is if you just look at the approval ratio, once this information was available, you see that market-wide approval ratios on average go up for all of these counties after the establishment of this annualcreditreport.com website. Now, this could be potentially because of supply side changes, could be because of demand side changes. And Amit does an extraordinary job of trying to nail down why it is the demand side change, which is all very convincing. So I have 3 or rather 4 quick comments to make. The first comment is about what do we learn? So the big picture story is that cheaper credit reports improve credit market outcomes, for be it for households or for market. Individual consumers are better off because it shows us that they are able to withdraw applications without having a record on their history, apply when you have actually a good history and didn't know about it, and perhaps also work to improve their credit history over a longer horizon. So by virtue of having access to the credit report, perhaps I figure out a way to change my household finances to improve my credit history. I think this is yet to be tested, Amit. I know you have a battery of tests, but this is perhaps something that's relevant for you to think about. Second is markets are also better off because information improves the quality of the loan pool because you're going to have much higher, better sort of placed individuals applying for loans. But firms also have a fewer applications that they need to reject because the credit the credit reports are playing the role that they ought to. This is assuming that there is no moral hazard. Okay, but we know that this is the period which had the highest jump up in subprime loans and all of these things. So it'll be important for us to understand how markets are better off, because you do talk about how credit market outcomes improve because of this. And I don't see a sufficient argumentation on why this is so. And perhaps it might also be helpful for the flow of the paper for you to organize them into individuals and markets in terms of the results. The second thing is that the control group comprises of counties that already had access to this information. Okay, so my question is, does an increase in the approval ratio, for instance, mean the free report in these control tracks that were provided before this FACTA came into existence was not that effective? Or does this mean that the equilibrium approval ratio for mortgages in the treated counties under a full information provision argument is different from the control tracks? So the assumption that you're working with at the moment is that all changes observed are demand side changes in the treated counties. But then That is true in the traditional diff and diff context, where you would think of the control group as somebody that has not received the treatment. In your context, the control group has got the treatment well before anybody else. Okay. This makes the interpretation of the coefficients a bit harder. You may have causal estimates here, but what is your causal estimate relative to? It is relative to the control group. But why would you think that the impact of information for the treated is going to be any higher than the control that has already received the treatment? So it's a bit like the Oxford COVID vaccine, right? Like, why would you have people who got 2 doses or 1.5 doses show that, the 1.5 dose worked better? It's a conundrum. Similarly, in your context, the conundrum is, why would somebody who got the treatment many years ago suddenly be
Vimal, you have 2
less sort
minutes.
of proclive, sort of interested in the mortgage market than these guys? So you need to explain why that is so. And for me to be able to use these findings, we need some anchor on what the equilibrium demand under full information provision is likely to be. Typically, this is the role the control group plays in all of the other studies, but not in your context. And in your context, what basically happens is that you have a puzzle where why does the treatment effect even exist? So you need to explain to me why that is so. And if not, you should at least try and discipline the empirical approach with mechanisms. So you talk about a self-learning mechanism, but you need to expand on why that is true and how you're testing for it. Okay, so let me use the subprime population estimate as a simple example here. So
Vimal, you have 1 minute left.
yeah, this is my last slide. I mean, the one after this, but yeah. So here it's essentially showing you that the subprime population decreased in these counties, in which case, my question to you is, why is it that it decreased in these treated counties, but not in the control counties that already the information available to them, right? What was different about it? So you need to show me why this is true. Okay. And then the last part is to do with research design. I think you can learn about what the impact of the first wave of free credit information was to begin with, and use that as an instrument in the second case, right? So think about it that way. So for example, you can take all of these states and then use exactly the same design, but ask what happened to providing information when the control group did not receive the treatment in the neighboring counties. Then you will have a full range of the equilibrium demand under full information provision. You will know the upper bound and the lower bound, which you have already estimated. And without understanding more about what happened because of the earlier credit report provision in these states, it's super hard for me to interpret or make any meaningful, draw any meaningful conclusions. It's a very important question. It's about public goods provision. I really like the idea and the topic. It's a great data set to answer the question. It's very interesting results, but I urge you to reconsider the design in terms of how you're defining the control group, and think about its implications to interpretation carefully. And also think about what self-learning mechanism or why information provision increases approval ratios even higher than the formally treated group. Because if you can't solve that puzzle, it's going to be very hard for you to pitch the paper when you go on the market. So thank you.
Thank you, Vimal. That was a great discussion. I completely echo your last three comments myself. And yeah, so the floor is open to questions. I see on chat that Ajay and Josh had a question. Could you please unmute yourself and ask the question? Thank you.
Yeah, so I think my turn to answer. So can I answer some to the Vimal's question, and then I can take the chat questions in the chat.
Sure, sure.
So yeah, so the first question on the moral hazard, that's one of the thing that comes in, that if with the philosophical question is that if we give too much information to consumers, and what if they start with this game where just marginal people come in and then they just default after taking these mortgages? So that is one thing that's the problem with like providing perhaps like full information. So there is a logic why like initially the banks or the system design was designed in a way that some information is kept away from the consumers. Now, luckily, in this case, we see that the bankruptcies or the defaults doesn't happen a lot. So that helps a little bit in understanding that at least this gaming didn't increase a lot on that sense. Perhaps one thing it has to do with is that the credit report information takes time and a lot of verification before changing. So that might be my hunch. But a set of the comments that are very, very related is with respect to the control group, which are already treated in the history, and why this change that happens now. Why are these new treated guys are able to do better than the control guys? That's an excellent question, and that applies to actually each of these results, like why the approval ratios increased, why they're defaulting less more now. So the idea there is that this is kind of like a change in terms of the composition. So as I was trying to argue in the beginning, is that there is this latent demand or the set of consumers which are not in the market. So if we see that compositional shift in which you have certain set of consumers which are not in the formal market, perhaps they're sitting on the fence because of this information issue. And if we give this extra information, and if this new set of consumers come into this formal net, then what we would see is that there is this jump which will be temporary. And I totally agree that in the sense now everyone is homogeneous. So this difference should iron out with respect to time. So if you look at the approval ratios, for example, we see that about after 4 years, around 3 to 4 years, the effect starts to go down. So the working assumption that is needed here is indeed that the control groups would not have gone differently. Then this extra that we see that's happening because of this new information coming in, and it appears that these guys suddenly started doing better. It's actually because
But
there is.
shouldn't information provision be a permanent effect? Why are you arguing it is a temporary effect?
So the effect should be permanent, but since the other guys, the control guys have already been treated. So what these new set of new states or the newly treated states should happen is that they should, over a longer time, they should reach to the same outcomes that the control areas have. So they should converge to the similar outcomes. Because if the information has the same effect, then it should have the same effect on the control and the treated. Only thing is that these guys are receiving treatment now. So at the end, they should converge at some point of time.
So yeah, just need to make these assumptions clear
Yes,
about the control group then.
exactly. Yeah, I totally agree. And now, so two sets of questions that comes is that why don't I look at those states when they got the reports early? So that's exactly like the one DID design is always that once a state gets the free credit reports, let's compare what happens with respect to the controls which are zero, which do not have the credit reports. One of the problem with that is that these decisions were actually very endogenous. I didn't put it into the paper, but one of the case, I think it was the case of Maine, when they adopted the free credit report laws in 1992, what happened is that in that state, in one city, by the mistake of the credit rating agency, the entire city was marked as defaulters, the tax defaulters. And because of that, all of those guys, if they went to the market to borrow anything, even a credit card, they would be denied. And their credit report was basically entirely wrong, but not because of their own fault, but because of the rating agency. And once the regulators realized that this happened, they put this law that, okay, now I'm going to provide free credit report to everyone who lives in my state. So that makes it a little bit hard in those cases if I compare, because the idea was that it was in response to something. But I totally agree that it is like in another sense, this study can be entirely replicated for all the 7 states in their original times when they actually got their reports. So I think at some point I should do that and make the argument even stronger. That would be, if we find the similar trends in those times, I think, yeah, you're right that makes the argument very clear. Now, so let's go to the questions in the chat. So there was one question about, was there a nice balance between the treated and the control? So when we look in the approval ratios, these two, in terms of the coefficients, they do seem to be the case that there is no differential trend into the treated and the control states. And in terms of the economics characteristics, which is like state level GDP or employment and other things that I have in the paper, these two states do seem very similar, these two set of states. But I do see that there is pre-existing differences indeed across these states, because the states are, like, by definition, they are different units. So for example, there is pre-existing difference in terms of like the level of the approval ratios. It was a bit higher in the control states. Uh, if I go to the next question, which is it possible that the impact is overestimated because of the housing bubble? So that's a fair question. Like because of this law that comes in just before the crisis, it does make the estimates a little bit dicey. That how do you estimate it? So the idea here is that since we are looking at very close geographic discontinuity, which is probably perhaps like 100 kilometer on one side and 100 kilometer on the other, and we are subtracting the difference from one side to the another. So that does help us to some extent rule out this excess origination that happened before the housing bubble. And the second thing was, in an alternate test, what I do is I remove any observation from 7 and 8. So let's go just 2 years after the reform, which is 2005 and 6, and let's go 4 years before the reform. So remove every observation that starts in 2007. We still receive a very similar estimates for all the results. So that gives us a little bit more confidence in terms of like how the financial crisis would have affected. So with the working assumption being is that the financial crisis shouldn't very differently affect a county that is in Colorado versus a county that is just next in, say, Arizona or Nevada. But that's a very valid concern. And then we have another question, which is, did the first wave of states did on different date? That's true. And we can do a study, so as I discussed.
So
Okay,
that's all
now,
the questions in the
yeah,
chat. Is there
yeah,
anybody else who wants to ask a question?
I have a question, actually.
sure.
You can hear me?
Yeah.
Okay, great. So I think this is really fascinating. This is an area that I have occasionally taught here in the States, and I think you've shed real light on a very interesting dynamic. The kind of minor question that I have is that at least some people, and I don't know how we would know how many, are accessing reports, not so much to find out information, about themselves, but to check for accuracy. And if there's any concern about identity theft, and then seek corrections. That was actually I think the motivation for the law to begin with. So to the extent that there's any significant number of people kind of in the sample who are doing that and actually able to correct information, then that would seem to be a different kind of mechanism, at least for the data, that suggests that they're actually changing their apparent creditworthiness, not necessarily changing their own view about their creditworthiness. And so I'm just curious whether you have any sense, if there's any way to find out, what portion of the group that might be, and whether that's already kind of accounted for in how you've analyzed the data.
Yeah, so thanks, Adam. That's actually a very relevant question, which was the initial motivation for this law when it was being debated, was that there happens to be a lot of errors in these reports. In fact, there were some of the Fed studies which said that they found like about 40% of the reports had some kind of error. There can be an error in the credit utilization or identity theft, which is another type of error. So now the idea is, can it affect the design and what we are trying to do here? So in one sense, the error also reduces the demand in some sense, that if I am really not sure that what is contained in the reports, and there is a chance, non-trivial chance, that there is an error, it might also have a demand suppressing effect if certain people for whom the cost of getting rejected is really high. So that's the idea that I take on in terms of this correctness of the information there and not being there. Now, from the economy point of view, which was also a question by Ajay here, is that the free. So once government is providing something free, obviously we know that nothing is free, and some way this cost has to go somewhere. So we know two facts about it. So once these credit reports became free, one of the things was that these credit reporting agencies were fighting really hard to not allow this law to come into picture, because they were worried that they need to verify all these new claims that consumers are going to access, and this will take a toll on their financial resources. Now they did pass on that cost. They basically increased the cost of their credit reports to the banks. So, but the point is that the number of checkings that the banks do is just too high. So in 2005, 1 billion credit reports were issued and less than 0.05% went to consumers, but everything else went to the banks. So basically the cost went on to them. The increase is, let's say, 50 cents on per credit report. So earlier they were checking for whatever, like $5. Now the bank has to pay to the credit rating agency $5.5. So I have the document where they pass on this cost. But if I can make a very last point, is
Yes.
that in terms of the
5
economic,
minutes over time, and we.
oh, okay, sorry, yeah. So just 10 seconds. So in terms of the economic efficiency, like who should actually have this burden of checking if the information in the credit report is right? So that's the point that I want to make, is actually it's the consumers who have the best information, who can actually verify if the information in the credit report is right or not. Because anyone who is third party, be it the banks, be it the credit report agencies, they rely on someone else, but it's actually the data of the consumer. So the best judge of this data is actually the consumers who in the economy, who can actually at the most costlessly do this correction or verification of the information. It just happens to be the case that they are the one who also have the incentive to lie there. So that's why we have these checks and balances. So thank you very much, and sorry to go over time. So thank you, everyone.
Thank you, Amit. Monami, over to you.